And horticulture, so we've got 2 years of data across the industry now, obviously. So we've got 2 years of pome and 2 years of vegetables, being that last 19, 20, 21 year. And I think the key part of this industry results is just that we've got 2 years of quite good returns for the top 25% and then lower ones. But what we're starting to see is this operating efficiency come out as the key component of where I think businesses need to really keep concentrating on, whether you're in vegetables, pome, and even other industries that aren't involved in this project at this stage. So, you know, the 2 year average close to 80%, you know, it's at 79%, 9% higher than we'd like you to be. Like there's 9% of income, which is going to costs that aren't being rewarded back. So the return on capital at 5.5%, arguably still a good return, better than cash returns. Arguably, is your capital better to be in the share market? Probably not in recent times, but these are the things that growers can make decisions on. And obviously, equity we mentioned was, you know, the businesses are in a strong position. So, yeah, look, and a couple of graphs at the bottom to just depict the difference between 19, 20, and you can see that variation. And I think when we get to vegetables, we'll really hone in on what the 5 year data set looks like, because you start to really pull out some interesting information on equity, return on capital, and operating efficiency, which are key drivers. In the horticulture findings, so across pome and vegetables, we've actually ranked the growers based on what we call operating efficiency, and that's basically the percentage of costs, so what you spend to make a dollar, and that's a key driver of profitability, is how well you actually turn your expenses into income. So just a distinct difference there, I guess, Bryn, to make sure that when we look at the top 25% in those graphs, is that the horticulture findings are about operating efficiency, which has a very, very high accuracy in relationship to profitability. So we're comfortable that we're actually ranking people on the right measure. And operating efficiency, this is again the single year results. So this is the percentage of costs as a percentage of income. So what that says at 78%, the average of the industry spent 78 cents to make a dollar. Now this is the engine room. So the lower that efficiency is, the better the business is at making money. And obviously that little grey line, or that grey part of the bar there, is contributing to overheads such as drawings in the business, interest, tax, depreciation. So that 78% number is really critical. We believe in the horticultural industry that target should be less than 70. So you can see the average of the industry is above that target, which means they've got less money left over after operating costs to actually pay for those overheads. So if you've got a high overhead business, you need that operating efficiency to be as low as you possibly can so you can contribute to those overheads. Yeah. And this is probably, again, depicting the year that it was. So their operating efficiency, it's at 80%, slightly higher than the year before. Yeah, so just, you know, it's a very important factor, and it just means that the costs that were employed to drive income were going up that year. So the income didn't respond, or the costs were higher. So a combination of both. So, you know, a really important metric that we use a lot of. And we then use this data for each of our growers to dive in and say, okay, what is affecting this operating efficiency in your business? So that's where the conversation starts.
Yeah,